There's no spike, no crash, no headline, just silence. 4 days. The price of silver has hovered around $63, unwilling to break higher, but refusing to fall. To most of the market, it looks like nothing is happening. No volatility, no news. Just a flat, forgettable chart. But beneath the surface, something's moving. Billions of dollars in contracts are being bought and sold rapidly, aggressively, and unusually. The volume is enormous. The price is not. That contradiction tells a story most people miss, because price doesn't always reveal the truth. Sometimes it hides it. What we're seeing isn't confusion, it's a confrontation. A concentrated effort to defend a specific price level, not from a trader chasing profits, but from a buyer too large to ignore. A buyer absorbing pressure from all sides and leaving no mark on the chart. This isn't speculation. It's strategy, and it's playing out right now in quiet, calculated accumulation. Hidden behind trading screens. Hidden beneath the visible orders. Hidden, but very real. Someone wants silver. Not some silver. All of it. And they're not chasing the price up. They're holding the line. When most people buy silver, it's simple. You log into a brokerage account, click Market Buy, and your order fills in seconds. You see, the price tick up a little, maybe a few cents. The transaction is done. No one notices, but if you try to buy $650 million worth of silver, around 10 to 15 million ounces, you cannot just hit buy. Doing that would explode the price instantly. The chart would melt upward. The market would panic. And the buyer would ruin their own entry. So smart money does something different. They use a strategy called an iceberg order. In an iceberg, only the tip is visible. A small order, say 5 contracts, sits quietly on the public order book. Hidden beneath it, inside private trading systems, is a massive concealed block of metal, ready to fill. Every time someone sells into those 5 visible contracts, the iceberg replenishes. Sell 5, reload 5. Sell 5, reload again to outsiders. The price appears stagnant, but the volume tells a different story. Trades fire. Liquidity drains. The level holds. This is not passive investing. This is a surgical extraction of inventory without triggering alarms. And when it's done right, exactly like what's happening now, the price doesn't rally. It just refuses to fall. This is how strategic accumulation works. Not by chasing candles. Not by sending signals, but by absorbing the float quietly, efficiently, until there's nothing left. You don't see the silver leave the market. You only notice when it's gone and the price has nowhere left to go but up. When big money arrives in a commodity market, the first question everyone asks is simple. Who is buying? Retail? Unlikely. The crowd that dreamt of a silver squeeze back in 2021 has long since burned out. Rising rates, inflation, fatigue, and a long sideways grind have taken the energy out of that movement. The volume today is too large, too steady. This isn't Reddit. Could it be a hedge fund? At this scale, most hedge funds do not touch physical commodities this way. They prefer leverage, speed, and exit strategies. What we are watching now is none of that. There's no drama, no chasing, no unwind, just quiet accumulation. How about the bullion banks? Maybe JP Morgan. After all, they've been active in metals for decades, but their typical activity looks very different. Banks lean short during rallies. They try to manage volatility, limit risk exposure, protect institutional clients. They don't defend floors like this. They aren't known for building long-term strategic inventories, so who's left? The buying pattern suggests an entity that isn't interested in trading. They're not here for gain. They're here for need. The orders are calm, systematic, and indifferent to short-term price movement. This isn't someone chasing momentum. It's someone buying for survival, and there's something different about the timing, too. The buying is happening around the clock during the U.S. pre-market. During the Asian Open, through the European sessions, that's not speculative timing. That's logistics coordination on a global scale. Who does that? Who executes billion-dollar orders across multiple sessions without blinking while defending a specific level for days? Only one kind of buyer fits this footprint, not a fund, not a bank, a corporation. A strategic buyer, someone who needs silver not to flip, but to function. Someone for whom $650 million is not a bet, it's insurance, and they're still not full. The deeper you look, the clearer the motive becomes. Silver has always had two lives, one as a monetary metal, the other as an industrial input. For decades, investors focused on the first inflation hedges, currency crises, and central bank policy. But the quiet buyer at $63 is not behaving like a monetary investor. They're behaving like a builder, a supplier, a planner, which leads us to an uncomfortable truth. This is not a trade. It's procurement to understand what's really happening. We have to zoom out, not just from the market, but from the moment. We're no longer in the era of digital speculation. We're entering the era of physical constraint. And at the center of that transition is one force more powerful than any Federal Reserve headline or CPI print: artificial intelligence. AI models like ChatGPT, Gemini, and Llama are not just software. They are infrastructure. They require massive compute power, running day and night across data centers the size of stadiums. Every AI query uses 10 to 30 times the energy of a traditional Google search, and powering those servers requires electricity. A lot of it, but here's the problem. The US grid is old, aging, and already stretched. And the tech giants, Microsoft, Google, Amazon, Meta, have made public commitments to go green. They can't build coal plants. They can't wait 10 years for nuclear. That leaves solar, fast, scalable, politically acceptable, and solar needs silver. Every panel requires it, in paste, in film, in cells. Silver is the best conductor of electricity in the periodic table. That makes it non-negotiable. So now, put the pieces together. Microsoft and BlackRock quietly announced a $30 billion AI infrastructure fund. Entire global silver mining industry produces only $25 billion of silver per year. Silver is now being silently stockpiled by the same firms building solar-powered data centers. This isn't guesswork. It's logistics. They're not buying futures. They're buying uptime, not a position, but supply chain security. The buyer at $63 is not a voice on a trading desk. It's a boardroom directive. For years, silver was dismissed as just another commodity, unreliable, volatile, caught between industrial use cases and retail speculation. But now a strategic buyer has absorbed a staggering amount of supply, not to profit, but to build. And that has created a chain reaction few are prepared for. Silver is not just used in solar panels. It is antimicrobial. It is critical in surgical equipment, burn treatments, and infection prevention. Hospitals rely on silver in everything from catheters to wound dressings. In military applications, it powers the batteries inside torpedoes and the navigation systems of cruise missiles. Fighter jet cockpits are coated in silver-based material for visibility shielding. None of these industries care about price volatility. They cannot wait for dips. They do not hedge. They buy what they need, and if it is not available, systems and lives are at risk. This is what economists call a crowding out effect. A massive new force, in this case AI-linked tech giants, enters the market and begins to absorb the available supply, not for speculation, but for core operations. And in doing so, they slowly and silently push everyone else aside. Medical inventory managers reach out to refiners and hear the same message: nothing is available. Military procurement officials begin to notice longer lead times and unfillable contracts. Silver has not just become more expensive, it has become unavailable. And those who still need it, governments, hospitals, defense contractors, are forced to bid higher. This is not a financial squeeze driven by short sellers. This is a manufacturing squeeze, where demand cannot be turned off and supply cannot suddenly appear. At some point, the last discretionary buyer gets pushed out. That means jewelry demand fades, bullion demand wanes. Cultural consumption, like India's silverware and ornaments, begins to contract. The metal becomes too valuable to wear, too essential to waste. And that is the moment silver stops being speculation and becomes infrastructure. In every commodity cycle, there is a moment that separates the curious from the committed. That moment is not the all-time high. It is not a media headline or a price spike. It is the silence before the move, the phase where the market feels slow, even dead. But beneath that stillness, something foundational is happening. The accumulation right now at the $63 level. That is exactly what we are seeing. A buyer, possibly a tech conglomerate, is absorbing visible and invisible supply without triggering price panic. Every contract sold into the market is being met with equal and opposite demand. Not by chance. By design, this is not about value anymore. It is about priority to the average investor. Silver is a trade. A way to hedge against inflation, against currencies, or against collapse. But to the buyer operating at this level, silver is not a hedge. It is a resource, as critical as steel, as irreplaceable as water, and when resources become constrained. It is never the most enthusiastic buyer who wins. It is the one who starts buying first. The accumulation will not last forever. At some point, the whale will be full. The iceberg orders will vanish. The price floor, once supported by constant demand, will be removed, and what happens next is not gradual. The market will enter a vacuum, a supply zone with no sellers because there are no holders left to sell. And in that vacuum, price discovery becomes violent. Will it happen tomorrow? Probably not. But when it does, the people watching will think the move came out of nowhere. You will know different because you were watching the volume. You were watching the base being built. You understood that when the price stayed flat, it was not weakness, it was strength preparing itself. We are not heading toward a speculative rally. We are heading into a new system where silver is no longer optional. What happens when something essential becomes unavailable and the market only realizes it after it is already gone?